Welcome, ladies and gentlemen, to Lesson 1, Financial Reporting and Financial Statement Basics. As you'll find throughout these lessons, accounting people are not very creative. So what we're going to discuss today in Lesson 1 are financial reporting and financial statement basics. Now let's start. If you look to your cheat sheet, bottom right hand corner, you'll see a pink box, the 5 W's of financial statements. Let's go through those. What? Financial statements report the operating business transactions of a company. They tell a story. What are financial statements? Financial statements are the story of a company's operations. Who uses financial statements? Essentially, people making decisions use financial statements. Primarily, people making decisions based on the information included in financial statements use financial statements. That's who. Why? We want to know how healthy a company is. We want to know what happened to the company during the year. We want to know how a company's financial position is at a certain point in time. That's why. So, why do we have financial statements? Because we want to know what's going on in the company. When? Well, for a public company, the when is quarterly and annually. The United States Securities and Exchange Commission, the SEC, requires that a company file financial statements quarterly and annually. Alright? If it's a private company, now it depends, because it depends on the investors. A private company, the investors could want financial statements weekly, monthly, quarterly, or annually, and they're required to do so depending on the type of arrangement they enter into. Typically, though, a private company is going to prepare annual financial statements. And so, now we get to the how. How do financial statements do all this? Tell people about the business, tell a story, let people make informed decisions. The how is, the financial statements include the operating, investing, and financing activities of the company. The operating activities are the day-to-day transactions. The investing activities are how they take money in and buy it out, or it's basically how they take the money out. The financing transactions are how they take the money in. The investing is how they take that money out to buy property, plant, and equipment, securities such as stock or bonds, and so that investing is the out, and the financing is how they get that money in from investors and creditors. Okay, those are the 5 W's of financial statements. Now let's move along and turn over our cheat sheet, and we'll go through the 4 types of businesses, and these are basic structures of businesses. The first one is sole proprietorship. And the concept behind the sole proprietorship is as a single person, and that single person is typically liable for the debts and any sort of liabilities that company incurs. So, like a plumber, for example, a plumber, he does it by himself. He puts an ad in the Yellow Pages. He goes fix people's drains. That plumber, he owns his own business himself. He's a sole proprietor. A partnership, similar to a sole proprietor, but it's 2 people now. It's a partnership. You can't have a partnership with just one person, but if you put 2 or more people together, you can have a partnership. And typically, partners, similar to the sole proprietorship, they're liable for the debts and liabilities incurred by the partnership. A corporation, separate from a sole proprietorship and a partnership, the debts of the company are separate from the owners. All right? So the owners of the company, the stockholders, aren't liable for the debts. The company itself is. The company is a separate entity. The company can enter into transactions. The company can be sued. That corporation is separate from the stockholders of that company. The stockholders are the owners. All right. That's a corporation. A limited liability company is kind of a blend between a corporation and a partnership. You get together 1 or more people that own a company, but like a corporation, they're not liable. Essentially, the limited liability company, it's for a tax purpose. It's taxed similar to a partnership, but it has the same sort of legal ramifications of a corporation. It's a new type of business structure that's becoming popular. You'll hear about it as you go through your business classes. Now we go. These types of businesses enter into business transactions, and now there's 3 basic types of business transactions. And if you remember from the other side of the cheat sheet, the how of financial statements, that there was 3 types of transactions that would go into the financial statements that say the how, and those are the 3 business transactions that we're talking about here: operating, investing, and financing activities. Now, if you'll skip down to the bottom of your cheat sheet, you have these charts in green. You say a service company. We got operating activities, investing, and then financing activities. But we got operating activities at 3 different types of companies: a service, merchandising, and manufacturing company. A service company, they sell service, receive cash, incur operating expenses, sell another service, receive cash, incur operating expenses. That's that cycle of that business, the operating cycle of that business. A merchandising company sells products, receives cash, buys more products, incurs expenses to get those products in the sellable condition, or to sell those products, sells them, receives cash, buys more products, incurs operating expenses. That's the operating activities, that's the operating cycle of a merchandising company. Manufacturing company sells products, receives cash, incurs operating expenses, buys raw materials, manufactures products, and then sells products, receives cash, goes through that cycle. Raw materials are like, say you buy steel to build a car. Well, that steel is the raw material that goes into the production of that car. All right, so that's a manufacturer. Let's look at some investing activities, and we're gonna talk about cash flows in from investing activities, and that's basically when we sell something that we invested in. If we invested in property, plant, and equipment to produce things, and then we sell that investment, okay, that's cash flow in from investing activities. Now, if we invested in a stock or something, and then we sold that stock, well, that cash flow in from that investment is a cash flow in from investing activities. Cash flows out, like I said, is purchase of property, plant, and equipment. It's purchases in securities, purchases in stocks or something. That's an investing activity that's going out. The cash is going out the door. Financing activities. Cash flows in from financing activities are cash flows where we get money from investors, we get money from creditors. That's a cash flow in from financing transactions. A cash flow out is, say, we repay that debt, we repay that creditor what we bought or what we borrowed. Similar, if a stockholders are going to want a return on their investment, and that return is usually in the form of dividends, and dividends are cash flow out from operating activities, or we can repay them their initial investment. All right, so these are examples of the types of business transactions that we're talking about up here. Now, all those business transactions are put together and they're put into financial statements. And now we're going to get into what those 4 basic financial statements are: balance sheet, income statement, statement of retained earnings, statement of cash flow. One thing to note: a principle of accounting is this separate entity assumption. The separate entity assumption is basically saying these financial statements are just of one company. It's just these financial statements are of a separate entity. It doesn't include the business transactions of another company. It only includes the business transaction of this company. Also, negative amounts are reported in parentheses in the financial statements. We'll get into that later as we go through financial statements, but just one thing to note. Now, let's talk about the 4 basic financial statements. Let's talk about what a balance sheet is. Go up here. A balance sheet shows the financial position of a company at a given point in time. It's our cash balance at this point in time. It's the amount owed to us at this point in time, amounts owed to other people at a point in time. Balance sheet is a picture of the company at a point in time. All right, it's a picture of the assets, liabilities, the resources that they own, the debts that they owe at a point in time, a specific date. All right. The balance sheet follows the basic accounting equation, and this basic accounting equation is going to follow us through all the lesson plans. The basic accounting equation is assets equals liabilities plus stockholders' equity. Remember that. Assets equals liabilities plus stockholders' equity. The basic accounting equation. It's going to follow us throughout the lessons. Moving on to the income statement. The income statement, different from the balance sheet, which is just a point in time, the income statement shows us the results of operations of the business over a period of time. It could be a week, it could be a month, it could be a quarter, it could be a year, but it's over a period of time. It's what transactions happened during this month, during this week, during this quarter, during this year. What transactions happened? Okay, that's the income statement. And going back to when we talked about the operating activities, we're talking about selling goods. Okay, so the income statement shows our revenues. Anytime we sell a good or a service, that's considered a revenue. The revenues go into the financial statements, into the income statement. One thing to note, the main rule of all reported revenues is that revenues are reported when the product or service is given to a customer, not when cash is received. It's an important concept to note, but we're going to move on. Except expenses. Alright, expenses, like you see down here, in our operating cycles, our business transactions, we incur operating expenses to sell products. Alright, either because we bought the product or we manufacture the product, we incurred operating expenses, we incurred expenses to sell